Welcome to Online Trading Campus. This is Jan Skoropinski with you today, continuing the new 2020 Forex course. Welcome back to Module 3, Professional Forex Trader, Lesson 3, Risk Management. The agenda for today is designed to ensure you know the possible risks of navigating in the Forex markets. Not just understanding the risks, but more importantly, understanding how you can professionally manage them. First, we will talk about trade execution. In specific, we will talk about the stop loss parameter. After which, we will go into spreads, which will focus on entries. At the end of this lesson, I want you to be a professional Forex trader. Therefore, you need to understand some of the Forex specific characteristics and how to scientifically and mechanically manage them or act on them. And lastly, we will quickly rate the risk of gaps in the Forex markets, which you probably already know are quite low. However, it is still worth to look at times this may still happen also in Forex. We have already talked about the wiggle room for the stop loss parameter, but let me introduce this topic to you formally relating to the Forex market. Because especially when we talk about gold or silver or CFDs or CFD futures later, it will be important to use an adequate amount of protection as we are trading derivative products. So we know to place our stop losses below the distal using the 33% rule. But there are also other important factors we should be looking at to further protect our positions, including wick over wicks and even numbers. Let us first look at the basic mechanical way to place the stop loss also in Forex using the 33% rule. You can either do this manually or you can use TradeStation to easily calculate the wiggle room using the so-called Fibonacci tool. Here you can see a nice rally-based rally on the weekly Euro USD. And for the purpose of this exercise, let us just assume you want to set this specific demand zone. The proximal is at 1.12954 and the distal is at 1.11686. The size of the zone in terms of pips are 127 pips. So we should add a stop loss below the distal mechanically calculated with a size of 33% of the zone. 33% of 127 pips are roughly 42 pips. 42 pips below the distal is where we should place the stop loss. So 1.11686 minus 0.00420 is 1.11266. This would be the manual way of calculating the stop loss. Fortunately, we have our Fibonacci tool which we can use to calculate the stop loss for us. We simply double click on the Fibonacci lines and add a minus 33% line. To note here is that this only works if you first place the proximal, then the distal. This way your proximal becomes the 1 or 100% line and your 0 or 0% becomes the distal line. And voila, the SL is placed at 1.11269 as per our manual calculation. Now here's the deal. Once you place your stop loss, your job is not quite done. Next, you should check where your SL is placed in terms of potential wick over wicks or even numbers. In this example, we can see that our SL is placed within a wick over wick. Now here we probably have to quickly talk about what this implies. A wick over wick implies that we can find a supply or demand imbalance if we go to the next smaller time frame. We're looking at a weekly chart, so if we go to a daily chart, we will see a daily demand zone, which would become almost a daily level on top of level on a daily chart. As per the rule, we should further protect ourselves here. Before we go to the lower time frame, also note how the lower wick is at an even number at 1.11 right here. Once again, this means we should protect ourselves even further. So let us now go to the daily chart. And what do we see? We see a daily demand zone, a rally-based rally just where we had a weekly wick over wick. Here we would place our SL just below the 1.11 mark, maybe 15 pips below at 1.10850. In general, I would like you guys to be navigating as safely as possible within the financial markets in the spirit of safety first. Also, oftentimes these wick over wicks are traps that are going to be tested by price. Not always, but sometimes. So here we will have to find a way on protecting ourselves as much as possible, but also looking at profit margin in terms of risk to reward. Now, if we keep our entry at the original proximal, the zone becomes extremely wide and large, meaning we have or you have less profit potential as a result. Here you would have a couple of options. First and most obvious option is to lower the proximal line to achieve a better or lower entry point. Here the problem would be that we may not be filled. Second option, and the more advanced way, would be to wait for a signature or price action reversal, meaning waiting for price to show us the reversal, like a bullish daily hammer or engulfing candle. And once the reversal is confirmed, we would trigger this either based on our price action set of rules. Trading Forex, we could also wait for the Monday 5 p.m. Eastern close combined with lower time frame trading hour zone qualifier to create a hybrid where you would trade within weekly demand but waiting for those signals to achieve the most probability and most profitability on the trade execution. The next risk management topic is going to be spread and how spread relates to order execution. For most liquid Forex pairs like majors and minors, this topic isn't really relevant due to the size of the spread. However, this will become relevant for CFDs, exotics, and especially trading smaller time frames like daily income, because for those products, depending on the broker, spreads can be extremely wide. As you've learned in one of the first lessons, Forex brokers make you and I buy from the ask and sell from the bid. This is because depending on the product, the spread could be so wide that also charts would not be smooth. They would be extremely choppy. And in the effort to smoothen out charts, most brokers will only show you the bid charts. Therefore, when we're buying from a willing seller, ask. Therefore, we may be affected due to spread. This is because we only see the bid price in the charts and the ask price is higher than the bid price. When we are selling, we're selling to a willing buyer, bid. Therefore, we are not affected. My recommendation here is that on buying orders, mostly entries, but could also be applied to stops and targets depending on the size of the spread, we can add spread to ensure we are filled at the desired price. This is the cheat sheet for your Forex and CFD order execution. For a long position, ensure you're adding spread to the entry, especially when trading daily income CFDs on any income objective and exotic pairs as well on any income objective. This all comes down to accuracy. And again, the smaller the time frame and the higher the spread, the more accurate we need to be. Here, the stop and the target are sell orders, so we would not be affected with those. We can leave them untouched. For a short position, you are not affected on the entry because the entry is a sell position. The stop and target are buy orders, however, and therefore it is optional for you to add the spread for further wiggle room. And this is spread dependent really. As a rule of thumb, I want you to focus on your buy entries because this is where we need the most accuracy, especially on level on top of level cases when we trade smaller time frames like daily income, and on the stop loss, we anyways have plenty of wiggle room within the 33%. That is to make your lives very, very easy. And on the targets, the same would apply. So to drive this home for your understanding, let us assume you're looking at a daily demand zone on the euro with an entry at the proximal at 1.14110. All I want to focus on here is spread and your execution on the long entry. First of all, note that current price is trading at 1.19055. This is the bid price, which you can see to the left here and also here to the right under the sell button. Meaning this is the price you can sell at. Also meaning you are looking at bid charts. Secondly, note the buy button price of 1.19072, which is roughly 2 pips above the bid price. This is the ask price, and the difference between bid and ask, is the so-called spread. So we would know that the spread is roughly 2 pips. Let us assume that price is coming down, just touches the proximal of 1.14110, and then reverses and rallies back up from there with an entry of 1.14110. We would not be filled, and therefore we would not be in this trade. Why? Because when we are buying from a willing seller. We are buying at the ask price, and the ask price would be 2 pips above the bid price. In this case, it would have been at 1.1413. Now, how could we scientifically manage this risk of not being filled? We would simply add the spread to the proximal entry. So here we would add 2 pips to 1.14110. In this case, our entry should be 1.1413. And lastly, if you're going short, this doesn't matter because you're selling to a willing buyer. You are selling at bid, and the prices you see in this chart are bid prices. So you would be filled at the price shown in the chart. The last topic on professional risk management are so-called gaps. Here you can see the daily chart for Intel. And as you can see, there are massive overnight gaps either to the upside or the downside. Just looking at the latest gap from roughly $60 to $52 per share, this is a price drop of more than 10% overnight. As you're aware, this is one of the negative characteristics of stocks, which is why we only trade stocks with large income objectives, ideally weekly or monthly income. So first, let us look at what gaps are and why we have to recognize them as a potential risk even in the Forex markets. Gaps are empty or white spaces between two candles. Whenever an opening price of a candle is different to the closing price of the previous candle, we call it a gap. Usually this happens whenever markets are closed and then reopened. Gaps are very common in the stock market due to the restricted opening hours. NYSE opens at 9:30 Eastern and closes at 4 p.m. Eastern. The gap risk is the risk of a market gapping against the direction of our position. This can lead to incalculable increased risk. In the Forex markets, there's a very low risk of gaps as markets are constantly open, and therefore we can always manage our open trades and ensure we can enter or exit markets at the desired calculated price. However, we still have to recognize that over weekends, gaps may still occur in case of increased volatility over the weekend. This usually happens if there's a scheduled news event, but sometimes this can also be unscheduled and random. Or if you're holding markets over the weekend that are not as liquid, like exotic currency pairs or some CFDs like agriculture CFDs. Therefore, it is recommended to also watch the futures course and familiarize yourself with each of the markets using the demo account before trading them live. Good news is that all of or most of these volatile news events happen knowingly. Therefore, it is recommended to always have an eye on the economic calendar, and in case there are volatile scheduled news events like the Brexit votes, presidential elections, or interest rate decisions, then it is recommended to close your position over the weekend and only join back in the next week or not participate at all. Alright everyone, this was the final lesson of the third module, Professional Forex Trader. Up next, module 4, Expert Forex Trader, really focusing on economics and Forex and combining the two. I will catch you all for the next module. Thanks everyone, and until then, happy and safe trading and ciao.